In this video, I'm going to cover tax-aware budgeting, the hidden financial habit that builds long-term wealth. In today's world, many people believe that financial success depends primarily on how much money they earn. While income certainly matters, history and real-life experience consistently demonstrate that wealth is often determined not by how much money enters a person's pocket, but by how effectively they manage what remains after taxes. This is where the concept of tax-aware budgeting becomes important. Tax-aware budgeting is the practice of incorporating tax considerations into everyday financial decisions, allowing individuals to maximize savings, reduce unnecessary tax burdens, and build long-term wealth more efficiently. Although taxes are often viewed as a once-a-year concern, financially successful individuals understand that taxes influence nearly every aspect of personal finance, from spending and saving to investing and retirement planning. The psychology behind tax-aware budgeting begins with understanding how people naturally think about money. Behavioral economists have long studied the tendency known as present bias, which describes the human preference for immediate rewards over future benefits. People often focus on the pleasure of spending money today while underestimating the long-term consequences of their financial choices. For example, an individual who receives a substantial bonus at work may immediately spend it on luxury purchases without considering the tax implications or the opportunity to invest part of the money for future growth. Months later, they may find themselves facing an unexpected tax bill or wishing they had saved more. This behavior is not necessarily a result of poor intelligence, but rather a reflection of natural psychological tendencies that prioritize short-term gratification over long-term planning. Tax-aware budgeting helps overcome this psychological challenge by encouraging individuals to think beyond the present moment. Instead of viewing taxes as an annual inconvenience, tax-aware individuals recognize taxes as a continuous factor that affects every financial decision. This shift in perspective promotes greater financial discipline and allows people to make choices that align with their long-term goals rather than their immediate desires. One of the most well-known examples of tax-aware financial thinking is Warren Buffett. Widely regarded as one of the greatest investors in history, Buffett's extraordinary wealth is often attributed to his investment skills and business acumen. However, another important factor behind his success is his understanding of tax efficiency and long-term compounding. Buffett has repeatedly emphasized the value of holding investments for extended periods rather than constantly buying and selling. This strategy not only reduces transaction costs, but also minimizes taxable events, allowing investments to grow uninterrupted for decades. To understand the power of this approach, imagine two investors. The first investor frequently buys and sells stocks, generating taxable gains each year. The second investor follows Buffett's philosophy and holds quality investments for the long term. Because the second investor pays fewer taxes along the way, more money remains invested and continues to earn returns. Over a period of 20 or 30 years, this seemingly small difference can result in dramatically higher wealth accumulation. Buffett's success illustrates a critical principle of tax-aware budgeting. Financial growth depends not only on earning returns, but also on preserving those returns from unnecessary taxation whenever legally possible. Another inspiring real-life example is Ronald Read, a man whose story surprised financial experts around the world. Read worked as a gas station attendant and later as a janitor in Vermont. He never earned a high salary and lived a relatively modest lifestyle. Yet when he passed away in 2014, it was revealed that he had accumulated approximately $8 million in wealth. Financial analysts who studied his life discovered that his success was not the result of extraordinary income, but rather consistent saving, patient investing, and long-term thinking. By avoiding unnecessary spending and allowing his investments to grow over decades, Read demonstrated that financial success is accessible even to ordinary individuals. His story highlights an important lesson. Disciplined financial behavior and efficient money management often matter more than income level. Despite the benefits of tax-aware budgeting, many people make costly mistakes that undermine their financial progress. One common mistake is failing to take advantage of tax advantage accounts, such as retirement savings plans. These accounts often provide immediate tax deductions, tax-deferred growth, or tax-free withdrawals under certain conditions. Individuals who ignore these opportunities may end up paying significantly more in taxes over their lifetime. Another common mistake involves tax refunds. Many people view a tax refund as extra money and spend it impulsively on vacations, electronics, or other discretionary purchases. Psychologists refer to this behavior as mental accounting, a cognitive bias that causes people to treat money differently depending on its source. In reality, a tax refund simply represents money that belonged to the taxpayer all along. Tax-aware individuals often use refunds strategically by paying down debt, building emergency funds, or investing for the future. Tax awareness is especially important for entrepreneurs and self-employed professionals. Consider the example of a freelance graphic designer earning $100,000 annually. Without proper planning, the designer may spend income as it arrives and later discover that a significant portion is owed in taxes. This can create financial stress and cash flow problems. In contrast, a tax-aware freelancer sets aside a percentage of each payment for taxes, tracks deductible business expenses, and contributes to tax-advantaged retirement accounts. By incorporating taxes into the budgeting process throughout the year, the freelancer avoids unpleasant surprises and maintains greater financial stability. Psychological research also highlights the importance of reducing decision fatigue. Every day, individuals make countless decisions about spending, saving, and investing. The more decisions people must make, the more likely they are to experience mental exhaustion and poor judgment. This is why many financial experts recommend automation as a key component of tax-aware budgeting. Automatic transfers to savings accounts, retirement contributions, and investment accounts help remove emotion from financial decision-making. Rather than relying on willpower or motivation, automated systems create consistency and ensure that financial goals remain on track. Many successful investors and wealth builders attribute their achievements not to extraordinary discipline, but to systems that make positive financial behaviors automatic. Building a tax-aware budget begins with understanding after-tax income rather than focusing solely on gross earnings. Individuals should evaluate how much money actually reaches their bank account after taxes and plan their spending accordingly. They should also allocate funds for future tax obligations, particularly if they're self-employed or have variable income sources. Maximizing contributions to tax-advantaged accounts, considering the tax consequences of investment decisions, and regularly reviewing financial plans are additional steps that support long-term success. These practices transform budgeting from a simple spending plan into a strategic wealth-building tool. Ultimately, tax-aware budgeting is more than a financial technique. It is a mindset rooted in long-term thinking and psychological discipline. The stories of Warren Buffett and Ronald Reagan demonstrate that wealth is often built through patience, consistency, and intelligent financial planning rather than extraordinary income. Their experiences show that understanding taxes can significantly influence financial outcomes over time. While taxes may seem like an unavoidable expense, the way individuals manage them can determine how much of their hard-earned money remains available to grow and create opportunities. In conclusion, tax-aware budgeting offers a powerful framework for achieving financial security and long-term prosperity. By recognizing the impact of taxes on income, spending, saving, and investing, individuals gain greater control over their financial future. The psychological benefits of future-oriented thinking, combined with practical budgeting strategies, can help people make better decisions and avoid common financial pitfalls. Whether one is a high-income professional, a small business owner, or an ordinary worker striving for financial independence, tax-aware budgeting provides a valuable path toward preserving wealth and achieving lasting financial success. As Warren Buffett's investment philosophy and Ronald Reagan's remarkable life story illustrate, financial success is not solely about how much money is earned. It is about how effectively money is managed, protected, and allowed to grow over time. Thank you for watching. In the next video, I will cover budgeting mistakes people make in their 20s. If this video helped you understand budgeting better, subscribe to Budget and Build for more beginner-friendly finance tutorials.